Welcome to today's What Moved the Market show. I'm your host Prem. It's Tuesday, January 20th, 2026, and here is everything you need to know as the markets close for today. Indian equity markets extended their selling spree today, with both the Nifty 50 and Sensex concluding the session in deep red amid a perfect storm of global trade tensions, persistent foreign investor outflows, and weak corporate earnings. The Nifty 50 closed at 25,232, down 353 points, or 1.38%, while the BSE Sensex fell 1,065 points to settle at 82,180. Both indices hit their lowest closing levels in over 3 months, reflecting the return of risk-off sentiment that has defined the start of 2026. The market opened nearly flat this morning but accelerated its decline as the day progressed, weighed down by fresh threats of tariffs from US President Donald Trump aimed at European nations over a dispute regarding Greenland. This geopolitical escalation has forced a broad reassessment of global growth expectations and triggered a wave of safety-seeking among investors worldwide. Within this bearish environment, foreign institutional investors continued their aggressive selling, offloading a net 3,260 crore rupees today as part of their massive January outflow of 29,300 crores so far this year. Despite strong support from domestic institutional investors buying 4,234 crore rupees, their efforts proved insufficient to stem the broader sell-off. On the currency front, the Indian rupee breached the psychologically significant 91 per dollar mark for the first time, marking a fresh record low as weakness in domestic equities and sustained dollar demand took their toll. The rupee opened at 90.93 against the greenback and extended its decline through the day, touching an intraday low of 91.01. This marks the rupee's depreciation for 4 consecutive sessions, with nearly 1.1% lost in just the first 20 days of January alone, adding to the woes of both foreign investors and importers, and further amplifying the bearish sentiment in the market today. Turning to the top performers and underperformers of the day, Dr. Reddy's Laboratories emerged as the strongest performer in the Nifty 50, gaining 1.94% or 22.7 rupees to close at 1,189.9. buoyed by strength in the pharmaceutical sector despite broader market weakness. Tata Consumer Products added 1.74% or 20.6 rupees, closing at 1,200.8. HDFC Bank, which continues to show relative resilience, gained 0.4% despite the heavy selling pressure all around. On the loser side, the weakness was far more pronounced. Bajaj Finance suffered a 2.13% loss, shedding 5.85 rupees to close at 269.80. Sun Pharmaceuticals fell 2.34% as profit booking gripped the entire pharma pack despite Dr. Reddy's strength. Apollo Hospitals dropped 2.12% to finish at 6,981.5. Among mid and small cap names, the selling was even more intense, with stocks broadly down 2% or more across the board. The India VIX, the market's fear gauge, surged above 16 levels, indicating heightened anxiety and extreme volatility expectations among traders as positioning gets squeezed on both sides. No new IPOs were launched today, keeping the focus entirely on the deteriorating fundamental backdrop. On the technical front, today witnessed critical support levels being tested on both the Nifty 50 and Bank Nifty. The Nifty 50 opened above the 25,500 level but quickly fell through it as selling intensified. Intraday, the index swung between 25,585 on the high and 25,171 on the low, ultimately closing near the lower end of the range. The key support zone of 25,400 held, but just barely, suggesting extreme fragility at these levels. A decisive break below 25,350 would expose traders to fresh downside toward the August 21st swing high at 25,125. For Bank Nifty, similar patterns emerged with the index opening around 59,900 but unable to sustain those levels. Bank Nifty tested the 59,700 zone multiple times intraday, but lacked the conviction to hold above it, eventually closing in the mid-59,600 to 59,700 range. The 59,500 support area held during today's sell-off, but any breakdown below this zone could lead traders toward 59,300 and the 20-day exponential moving average at 59,000 to 59,200. Sector performance today reflected the risk-off environment, with realty stocks taking the hardest hit, dropping more than 4% as weakness in the IT sector, and broader concerns about urban luxury housing demand in the face of tech layoffs hammered the index. The Nifty Realty Index plummeted 789.9 points, marking one of its worst days in 6 months, with Oberoi Realty falling 9% on disappointing Q3 results. Information technology stocks fell close to 2%, continuing their recent sell-off as global growth concerns persist and earnings outlook remains uncertain. Pharmaceuticals managed to stay relatively stable, with Dr. Reddy's gains offsetting weakness elsewhere in the pack. Oil and gas stocks also declined sharply as geopolitical tensions temporarily bolstered crude prices, but broader growth concerns overwhelmed any commodity-driven support. Consumer staples and FMCG were among the few beneficiaries, providing defensive appeal amid the chaos. Banking stocks, despite hosting the Sensex and Nifty's heavy components, declined about 1 to 1.5%, indicating broad-based weakness even among defensive plays. On the regulatory front, SEBI released a significant consultation paper on January 19, proposing a framework to regulate significant indices based on a quantitative threshold. Specifically, SEBI has proposed that index providers administering benchmarks linked to domestic mutual fund schemes with cumulative assets exceeding 20,000 crore rupees would need to register with SEBI under the newly notified Index Providers Regulations of 2024. This framework would apply to major benchmarks including Nifty 50, Nifty Bank, and others that meet the threshold. Index providers have been given 6 months from the issuance of the final circular to apply for registration and comply with stringent governance and transparency norms. Public comments are being invited until February 10, 2026. Indices already regulated by the RBI, such as those classified under the RBI Act, remain exempt from SEBI's purview. This regulatory move signals SEBI's intent to strengthen oversight of market benchmarks, particularly given their widespread use in passive investing and performance tracking by the mutual fund industry. Commodity markets took center stage today as precious metals surged to all-time highs amid the global risk-off shift and safe haven buying. MCX gold soared to fresh peaks above 1,45,000 rupees per 10 grams today, adding multiple thousand rupees in a single session and reflecting strong worldwide demand for bullion as investors flee equity markets. MCX silver witnessed an even more dramatic surge, crossing 3,16,000 rupees per kilogram or 315 rupees per gram, marking a historic milestone and demonstrating the intensity of precious metals rally this month. Crude oil markets meanwhile remained range-bound with Brent crude holding around $64 per barrel after gaining 19 cents on the session and WTI March futures closing near 59.68 after adding 8 cents, with both contracts showing resilience despite broader risk-off sentiment as geopolitical supply concerns continue to provide underlying support for energy prices. The escalating trade tension centered on US President Donald Trump's demand for Greenland control has roiled global markets and dominated sentiment today. Trump announced on January 17 that he intends to impose a 10% tariff from February 1 on any goods sent to the United States from Denmark, Norway, Sweden, France, Germany, the Netherlands, Finland, and the United Kingdom, unless the US is permitted to purchase Greenland. Should these negotiations fail, tariffs are set to increase to 25%, creating massive uncertainty for European exporters and downstream global supply chains. An emergency EU summit has been called to discuss a coordinated response, and the US Supreme Court is expected to rule on January 21 regarding the legality of Trump's existing tariff proclamations under the International Emergency Economic Powers Act framework, potentially changing the entire scenario. This geopolitical wildcard has triggered massive de-risking across emerging markets, with India bearing the brunt as foreign capital continues its exodus. Looking ahead to tomorrow, the Nifty 50 faces a critical juncture at these levels. The index needs to hold above 25,175 to maintain near-term stability, as a break below would expose traders to 25,000 to 25,100 on a short-term basis. On the upside, immediate resistance sits at 25,350 to 25,400, with a larger hurdle at 25,500. Bank Nifty similarly needs to defend the 59,300 zone to prevent a slide toward 59,000 to 59,100. A recovery towards 60,000 would provide relief, but traders should remain defensive given the continued headwinds from FPI selling and tariff concerns. The market is likely to remain volatile and range-bound until the Supreme Court ruling on January 21 and any concrete developments on the Greenland tariff front. Expect sharp intraday swings on any headlines, with selling expected to accelerate on rallies and bounces likely near critical support levels. Consider this a trader's market where discipline and risk management trump conviction. Here is your actionable takeaway for tomorrow. With crude above $64 and gold at record highs, commodity-driven outflows are likely to persist, particularly in stocks exposed to energy and industrial metals. If you are holding anything in energy or basic materials, consider taking partial profits into any morning rallies above today's intraday highs to lock in gains. Conversely, defensive plays like consumer staples and select pharmaceuticals like Dr. Reddy's or Cipla, showing relative strength, might offer compelling risk-reward on dips towards support levels we discussed. Watch the Supreme Court ruling on tariffs closely as the open bell approaches, as a favorable ruling could spark a short covering rally, while an unfavorable one might accelerate selling. Bank stocks, despite today's pressure, have crucial support at 59,300 on Bank Nifty. A hold above this level could attract value buying, making it a potential trigger point to watch. Thank you for tuning in to What Moved the Market. Please send in your questions and your trades through our listener forum, and be sure to join us tomorrow for our morning wrap as the markets open fresh. Stay disciplined, stay focused on your trading plan, and we will see you back here tomorrow. This is Prem signing off. Have a great evening.